Ron Mines with Geneva Financial. Just wanted to come to you and do a quickie video. We've been posting all week about refinances and why you should consider a refinance. And so I wanted to walk through a few more details with you with this video. And so from here, I'm going to run into my office and let's get into the details of the video. All right. See you soon. Okay, I've made it back to my office, so let's walk through some of these details on why you should consider refinancing. Reason number one, you should consider refinancing to lower your monthly payments. By refinancing, you can lower your rate, creating a lower monthly payment. If you want to save money each month, reach out. That's a true statement. If you've got a higher interest rate, and you can get into a lower interest rate, that will affect your payments in a positive way. How much money can you save? Well, that depends on a few factors. First, the interest rate difference. What is the difference between the interest rate that you currently have versus the interest rate that you're going to get? How much do you owe? Obviously, if you have a small loan size, it's going to be a small savings. If you have a larger loan size, it's going to be a larger savings. And then how long have you been in your existing mortgage? That's not necessarily going to be a savings difference, but what that'll do is kind of make up and I give you an idea of how many years that you should choose on the loan. Do you want to stay in a 30? Maybe you want to drop down to a 20, maybe a 15, even a 10. So those are important decisions. The minimum suggested savings should be about $110 a month or more. To make it worth your while. You could potentially save hundreds a month. Call to find out how much. So I'm telling you, if I can't save you at least $110 a month or more, then it's not worth your while at that point. But once you start getting to the 110 plus, then it is worth your while. I've seen refinances save $400, $500, $600 a month. It just depends. So give me a call. Let's talk about it. Reason number two that you should refinance, pay off all consumer debt. With a refinance, you have the option to pay off car loans, credit cards, IRS tax liens, and student loans, many, many more other kinds of loans as well. If you want the extra money to make progress on your debt, reach out to me today. Consolidating consumer debt can be very, very beneficial. It just depends on what your overall makeup looks like. So refinancing to pull cash out to pay off consumer debt could save you hundreds, maybe even $1,000 or more. Pay off installment loans such as a car, boat, motorcycle, RV. Pay off credit cards, student loans, pay off IRS debt. Now, if I just took my own personal self as an example, I don't carry a lot of debt, but I do have two car loans, one that's almost paid off, but another one that I just picked up, a brand new car. And then I've got one credit card. It carries a very, very small balance. And then I've got one installment loan that's, got $1,500 on it. But, if I went and paid off all those things in my mortgage by doing cash out, I would save over $1,000 a month right there. Just $1,000 a month. So that would, if I still had that same cash, I could use that $1,000 a month in a different way. Maybe I put it into my 401k. Maybe I put it into my regular savings account. Maybe I invest it in stocks and bonds, or who knows, crypto coin. You just don't know. Anyway, get rid of those annoying and stressful bills. If you're stressing out about bills, or you're stressing out about certain things, let's get rid of them. Let's just make them disappear, and it's all in your mortgage payment. Your mortgage payment's not going to go up that much. You're going to save a lot of money on the difference. All right, reason number three that you should refinance. Get rid of mortgage insurance. This is a big one. Up until this point, you've built equity in your home. Use that equity to remove mortgage insurance. Want to get paid for your time and effort? Reach out. And I'll explain that in just a second. So getting paid for your time and effort would be you're going to go through the refinance. On the other end of the refinance, you will reap the rewards. You will be saving a lot more money than what you're currently paying right now. So what is mortgage insurance? It's a policy that the lender made you pay for on a monthly basis when you took out the original loan. If you were to default on the loan, they would cash in that policy to help cover any losses when they sell your home. There's a little to no benefit to you as the borrower for mortgage insurance. So you want to get rid of that monthly debt as soon as you can. It could save you $100 to $350 a month off your payment. Just getting rid of mortgage insurance, not counting a new lower interest rate on your loan. So you could save $100 to $350 a month getting rid of mortgage insurance, and maybe you save another $200 or $300 a month because you lowered the interest rate on your loan. You could possibly even go to a 10 or 15-year mortgage and reduce the amount of years on your mortgage and still have the same payment that you've got today, or maybe even a little bit lower payment. So these are some very valuable things to look at. And what you've got to understand is your home is a tool. It's a tool that can be used to your benefit if you properly set things up. Call me today. Let's make this happen. A refinance will help you get rid of mortgage insurance, which will save you money. That's a very true statement. Number 4, reason you should consider a refinance. Having a lower rate equals lower payments. That was kind of said before, but here's where we're going with this. Based on if you have a 30, 20, or 15-year loan, you can cut time off of your loan and lower your payments. So reach out and talk about what works best for what you need. So here's a little bit more in-depth details. Lower interest rates gives you options. There's no doubt about it. It gives you options. Do you want to pay off your mortgage sooner? Do you want to retire earlier with a paid off home? Retirement security. When you go into retirement, you're not going to have the level of income coming in that you had in your working years. You're going to need some level of security. Part of the security would be a home that is bought and paid for. You don't owe a mortgage on it, and it allows you to live just a little bit easier knowing you don't have a mortgage payment. So that's what a refinance can do for you. With your lower interest rate, you could have the same or close to the same payment you have now, but much fewer years on your loan. Choose a 20, 15, 10-year loan instead of a 30-year loan. These are great options. The other thing I want to point out is that a 30 and a 20-year loan are priced pretty much at the same pricing. However, a 15 and a 10-year loan tends to be about a quarter of a point, sometimes as much as a half a point better than a 30 and 20-year pricing. So not only are you going to get the benefits of historically low rates compared to the rate that you last had when you took out the mortgage, but you're also going to get, if you choose a 15 or a 10-year, an additional quarter to half a point lower rate because you chose a 15 or a 10-year. So all that just means more and more money in your pocket, or reduced years and close to the same monthly payment that you've got now, or maybe even a better payment. And last but not least, number 5, you should consider refinance. Cash out or no cash out. Choosing a cash out option for anything you need, or choose a slightly lower rate with a no cash out option. Need to repair your bathroom or add a little extra to your savings? Reach out today. So let's talk about that and talk about some of the details here. Cash out or no cash out, you choose. Cash out for whatever reason you may choose, up to 80%. What do I mean by 80%? Well, we're going to do an appraisal on your property, and you're going to come in with a new higher value, much higher than what you had last time, because you've had appreciation over however many years since the last time you did a mortgage on your property. And we've had some very, very good, strong appreciation in Washington State in the last 4 or 5 years. So you're going to get this new high appraised value, and you can go to a maximum loan amount of 80% of that value, minus out your mortgage that you owe now. So the difference between what your mortgage payoff is and what your maximum loan amount is the cash out portion. So let's say hypothetically you owed $150,000 and the appraised value came in at $300,000. So 80% of $300,000 would be $240,000. and you owe 150, so that means $90,000 of that loan can be cash in your hand. That's money that you can do anything that you want to do with. Pay off debt, put it in the bank, put it in retirement savings, put it in stocks, buy Bitcoin or something like that. Whatever you want to do, that's up to you. The next is no cash out. It gets you a slightly better rate than a cash out. So it's usually about 1/4 of a point that you're going to save if you do a no cash out refinance versus a cash out. And so from that standpoint, that's 1/4 point. That could be anywhere from 20 to 30, maybe even as much as $40 a month difference just for the 1/4 of a point, plus the difference that you've got in the interest rate versus the interest rate you're getting today. So it could add up to several hundreds of dollars. The main thing that I want to kind of point out for you, you are in control. You choose just how you would like your mortgage to be set up. You tell me your goals, you tell me what you wanting to get done, and then I structure the loan in a way that works for you the best. And I give you guidance along the way as to, okay, you've got this option, maybe this option's a better option for you, but you tell me what works for you. And then we finish setting up the loan that way. We get it done. We close the loan. You have your cash in hand if you pulled cash, or you just have a lot better payment. Maybe you've reduced the years. There's a number of things that we could talk about. The main thing is call me today for a better tomorrow. It's a limited time. And the reason I say it's a limited time, interest rates are projected to go up this year due to administration changes. I'm not getting into politics. I'm just pointing out there's differences in administrations. And because there's differences, there's different effects on interest rate. They're widely expected to go up over the next year by at least a point. So if you want to get the historically lowest rates that you've ever seen, now is the time. You gotta call me today for a better tomorrow. Okay, so I made it back out here to my living room from my office, and I just thought I would talk to you real quick before the end of the video, and I hope you got some value out of that. I hope you understood that there's a lot of great options when you're looking at refinances. Even if you have an interest rate that isn't quite in the 4s, maybe in the 3s somewhere, you should be talking to me about your options for refinance. Do it while you can. Do it while the interest rates are still as low as they are. They are projected to go up this year. Gosh, I certainly don't want them to go up. Nobody else wants them to go up. But there's a window of time. So let's hit that window of time. Let's talk. Let's get all the details worked out. Let's get your loan done. All right. Hey, thanks for watching my video, and we will talk to you soon. Thanks. Hey, bye.